Welcome back, everyone. I hope you're having a good day today. Today, I wanted to go over a few mistakes that I see new and experienced investors make all the time. I thought today would be a great time to go over these as the market's making a deep downturn in some sectors. So let's get right into it. I could make a list of probably 50 or 100 different mistakes that I see all the time, whether it's on Twitter or YouTube or anywhere really. But I threw together 5 really quick that I thought were very prevalent that I see all the time. The mistake number 1 that I see is overconfidence. Investors overestimate their ability to invest dramatically, especially as new investors. An investor has to have a supreme temperament. This requires long-term patience, extreme discipline, and the ability to detach yourself from the mentality of the herd. More than 99% of investors should simply focus on buying an ETF like VOO, SCHD, or SCHD on an automated basis and simply focus more on increasing their income, reducing their waste on needs, and enjoying life. Investors in individual stocks have to have a deep passion for business. If you are simply investing in individual stocks because you want to compound your wealth quicker, you will almost always underperform the market and fall subject to failure in volatile markets. I see this all the time, especially with new investors. They think just because Buffett makes it sound easy, or they see other people online outperform over short periods of time, they think they should dive headfirst, skip the ETFs. But the reality is that investing into individual stocks is extremely difficult. Even Buffett says 1 in 100 people might have the temperament to handle the ebbs and flows of a market. That's without the understanding of the market. So I think the majority of people, probably most of you watching, most of your favorite content creators even, should honestly simply stick to ETFs. And this could honestly even be said for me. There's a great chance that I should not be investing into individual stocks, but I do love business. I do have a great passion for what this is. So even if I was to slightly outperform the market, it would be worth it for me, as this is one of my favorite hobbies. The second mistake that I see a lot is people trying to time the market. This requires an insane amount of luck for someone to successfully predict the direction of the market up or down over a short period of time. The correct way to go about this is to simply find the best businesses in the world, invest in those businesses at reasonable prices, continue to add to your positions when it's trading at a fair or undervalued price, constantly supervise those companies to ensure they're still maintaining the quality of investment that is necessary, and sit back and allow them to compound your capital for you. This is everywhere. You'll see people drawing lines on charts, doing certain analysis, saying that the market's going to go down over the next month, over the next year. The market's going to skyrocket over the next month, next week, next year, next day. All that is a speculation. That's all gambling. Sure, there's signals, but it's all related to what other people are going to do. And any black swan event could change the direction of the market at any given moment. The best thing to do is to play the long-term game. This is the only way that people have outperformed over a long period of time. Follow the Buffett Munger playbook. Invest into the best businesses in the world. Don't worry about any short-term noise. It's all going to go away. If you believe in America, if you believe in the world economy, and if you find the best companies to put your money into, they will grow your money over a long period of time. Mistake number 3 that I see all the time is settling for good companies. Oftentimes you'll see some of the best investors in the world make mistakes by simply trimming a great business due to a slight overvaluation, and then deciding to settle for a business of lower quality due to its selling at an undervalued price. The reason you want to stay in the very best businesses is because they are far more predictable over a long time horizon. A good, not great business may look fundamentally sound for the next year or two, but if they aren't bulletproof, all it takes is one chip in the armor for future projections to be shot down. You see it all the time where a value trap will look cheap year after year. However, due to factors such as increased competition, slowing growth, narrowing margins, secular headwinds, and other reasons, you can see a company continue to underperform a much more expensive company due to deterioration of business quality. I see this all the time with investors that call themselves long-term quality investors. For example, Google recently, it traded up to like a 32, 33 forward multiple, which is a little expensive, but it's a high-growing, high-quality company. It's almost bulletproof. And instead of sticking with Google, people would take their profits out of what was a fair valued, really great company and go put them into something undervalued, maybe a Pepsi, maybe a Pfizer, maybe a Novo Nordisk, something like that, something that's not near as stable, not near as high quality. And over time, those companies, if they do see any deterioration in their business models and their business quality, the more expensive Google will inevitably outperform, especially over, a decade or longer period of time. The fourth mistake I see people make all the time is mistreating an investment. Often investors think that in order for you to make sound returns on your investment in shares of a company, you are relying on people paying more for those shares down the road. While this can definitely be a way of making returns, you are not solely relying on that to happen. When you buy shares in a company, you are an owner of part of the business. If the stock market were to shut down forever, you would still own those shares, and over time, assuming you are invested into a successful business, extra free cash flows from the company would be returned to the shareholders. This comes especially from newer investors. They think that, just because I own $100 of Apple stock, that doesn't mean I, am a business owner. But you, by law, are. You own part of the company. And if the stock market were to shut down for 10 years, if you held onto those Apple shares and the company continued to print free cash flow per share, it continued to go up or even stay steady, all that would eventually be returned to the shareholder via dividends. If they weren't able to buy back shares anymore, either it would all sell on the balance sheet, which they wouldn't do, or they would return it to you via dividends. Even if you're in a company that weren't issuing dividends at the time, they have the ability over time to issue dividends if people aren't willing to pay for the stock. Mistake number 5 that I see all the time is investors are fishing in too big of a pond. This is very common, as investors will see other stocks either going to the moon or selling off steeply. They will think, due to the change in price, they need to do some quick research and decide quickly if this is an opportunity for them to hop into. This can cause massive destruction of capital, as it leads to impulse decisions on a business you aren't 1000% familiar with. Investors should slowly identify companies that are the best of the best in the investable universe, add them to a watch list to continue monitoring the business as well as the stock price, determine a fair value to pay for the company, and sit back and wait for opportunities to be presented to you within your watch list. The best way to go about this is you want to do research one company at a time. If you see flaws in the business model, you kick it out of the watch list. If you see it's a great opportunity, but it's trading at an elevated price, it's a little too pricey at the time being, just throw it on the watch list. Make sure the company is headed in the right direction, and over time, the stock market will give you a great opportunity to enter at a fair or undervalued price in even the best opportunities in the market. I currently have a watch list around 25 stocks, and I'm always watching those stocks. Every earnings report, every headline that I see, I try to pay attention to. If something changes with the thesis, if the direction of the company changes, if anything that I don't like starts happening with the company, I'll simply take it off the watch list. In the meantime, I'm waiting for a discount. I want to enter at a discount, and I want to stick in those companies, especially the highest quality, your best ideas. You want to stick with those and let them grow your money year over year, decade over decade. If you stick with those great companies, they will truly outperform the market. If you put your money into cheap, decent companies, even good companies, a lot of times one nick in the shield, one piece of deterioration, and the value is then kicked out of the door, and then you're stuck in a value trap for years to come. With that being said, that's all I have for today. I hope you got some value out of this. Make sure to subscribe on your way out, and have a good day.